You have probably been told to compare these three: index funds, ETFs, mutual funds. You cannot. Two of them are not even the same kind of thing, and that is not a you problem. Three names get lined up like three doors. One of them is not a door at all. It is what is waiting on the other side. Here's the part that breaks people. All three can hold the exact same companies, not similar companies. The identical list in the identical proportions. So if the contents can be the same, what on earth is different? That is the question this whole video answers. Start with one concrete difference. One of these can be bought at any second the market is open. Another can only be bought at one single price once after the US market closes. Meet Marcus and Jay. Both are fictional. We use them to make this visible. They are illustrations, not real people, not testimonials, not predictions. Same afternoon, same app, both buying a fund for the first time. And on the screen in front of them, three names holding the same underlying companies. Jay taps the first one the app shows him. Marcus asks one question before he taps anything. By the end, you will know exactly what that question is. Here is the promise. By the end of this, you will not be choosing between three things. You will be answering two separate questions, and you will know which is which. Three variables do all the real work. How you buy it, what it costs to run, and how the tax lands. One at a time. Picture three glass jars on a shelf. Same size, lined up in a row. Inside every jar, the exact same soup. Same ingredients, same proportions, made from the same recipe. Now here's the trick the words play on you. Index fund is the recipe. ETF and mutual fund are the jars. A recipe tells you what is inside. A jar tells you how the thing is built, how it is sealed, and how you get it off the shelf, which means asking index fund or ETF is like asking chicken soup or glass jar. They are not competing. They answer two different questions. Once you can tell which word is a recipe and which word is a jar, the confusion just stops. So let us do the recipe first. Every fund starts the same way. Money from a lot of different people is pooled together, and that pool buys a basket of investments. So a fund is not an investment. It is a container for investments. That one sentence is the spine of this entire video, which makes the recipe question simple. Who decides what goes into the pot? Recipe 1. A person or a team decides. They research, they choose, they change their minds during the year. That approach is called active management. Recipe 2. Nobody chooses. The fund copies a published list of companies, holding all of them, or a representative sample, in roughly the proportions the list says. That approach is called tracking an index. And that second recipe is what the words index fund actually mean. An index is just a list. The fund's job is to mirror the list, not to beat it. So notice what happened. Index fund never described a container at all. It described what is floating in the soup, which is why the same index strategy can be built as a mutual fund or built as an ETF. Same soup, different jar. Marcus spots this on his screen. Two of the three names he is looking at track the same index. The labels are different. The contents are not. Jay never checks. Not because he is careless, because nothing on the screen told him there was anything to check. So that is the recipe settled. Now, the jars. And this is where the real differences have been hiding the whole time. We are going to change one variable at a time. Same soup in every jar. First variable, how you get it off the shelf. A mutual fund does not trade on a stock exchange. You place your order and it does not fill at the price you were looking at. It fills once a day, at one single price, typically worked out after the US market closes. That price has a name. Net asset value, or NAV. Add up everything the fund owns, subtract what it owes, divide by the number of shares. So a mutual fund has exactly one price per day. Everyone whose buy order landed that day gets it. Everyone who sold that day gets the same number. An ETF is built the other way. The letters stand for Exchange Traded Fund, and Exchange Traded is the entire difference. Its shares trade on a stock exchange all day, like a share of a company. One price at 9:31 in the morning, a different one at 2 in the afternoon. And because it trades on an open market, its price is whatever buyers and sellers agree on, which can sit a little above or a little below the value of what is inside. One more practical gap. A mutual fund is bought from the fund itself. and many set a minimum dollar amount to get started. An ETF is bought on the market through a brokerage account, at whatever price it is trading at. Now watch the fork. Jay bought at 11 in the morning, and then refreshed the app for 6 hours while nothing moved. He thought it was broken. It was not. It was a mutual fund doing precisely what a mutual fund is designed to do. Neither jar is the correct one here. They are just built differently. Marcus was not smarter. He just knew which jar he had picked up, so nothing about the day surprised him. If that is the first time anyone has explained the once-a-day price to you plainly, that is what this channel is for. Subscribe, because the next variable is the expensive one. Every fund charges a running cost to operate itself. It has a name, the expense ratio. It is an annual percentage of whatever you have in the fund, taken out of the fund's own assets, a sliver at a time, which means no bill ever arrives. You never watch it leave. It has already been subtracted from the number you look at. 0.1%, 0.5%, 1%. Said out loud, those sound like rounding errors. So park this question, because we are coming back to it. Can a fraction of 1% a year actually matter? Hold that thought. First, one more thing that can hide inside a jar. Some mutual funds carry a sales charge, called a load, taken when you buy or when you sell. Others carry none at all. And here is the part almost nobody says out loud. The cost is driven more by the recipe than by the jar. Copying a published list is cheap to run. Paying people to research and pick is not. In 2025, index equity mutual funds averaged 0.0005% a year, while actively managed equity funds averaged 0.64%, which is why two funds in identical jars, holding overlapping companies, can carry very different running costs. The jar was never the thing setting the price. Third variable, and this one only shows up in the United States, and only in certain accounts. Watch where it applies. When a fund sells something it holds at a profit, that profit does not just sit there. It gets passed along to the people holding the fund. It is called a capital gains distribution. In a regular taxable account, you can owe tax on it in a year you did not sell a single share. Why would the fund sell anything? Sometimes the strategy calls for it. Sometimes other shareholders cashed out and the fund had to raise cash to pay them. Read that one twice. Someone else's decision to leave can create a taxable event for the people who stayed. ETFs are plumbed differently. Large institutions create and redeem ETF shares in kind, meaning the underlying securities are swapped rather than sold for cash. Because of that mechanism, ETFs have generally passed through fewer of these distributions. Generally, not always, and not by rule. And this whole variable mostly disappears inside a tax-advantaged retirement account, where distributions are not taxed as they happen. So, the same soup, in two different jars, can meet the tax system on two different days. Not because of what it holds, because of how the jar is built. Which finally brings us back to the question we parked. The one about a fraction of a percent. This next part is an illustration, not a prediction, and every assumption is going on the screen so you can check it. Take $10,000, leave it completely alone for 30 years. Assume a hypothetical 6% a year before costs, which is an assumption, not a promise. Jar 1 charges 0.0005% a year, the index average. Jar 2 charges a full 1%, which is what active equity funds averaged at smaller fund companies. Everything else is identical. Jar 1, growing at 5.95% after its fee, ends near $56,600. Jar 2, growing at 5% flat after its fee, ends near $43,200. So the gap the fee opened up is roughly $13,400, which is more than the entire $10,000 you started with. Same soup, same 30 years, same assumed return. One number quietly ate more than the original deposit, and it never appeared on a statement as a charge. That is the mechanism. No fund guarantees any return. Real years swing hard in both directions, and the 6% here is only a flat assumption to keep the comparison honest. And notice what I did not say. I did not say which jar. Both jars can hold cheap recipes and expensive ones. The cost follows the recipe and the specific fund, never the shape of the container. So look back at Marcus, standing there with his thumb over the screen, asking one question before he taps. Here it is. Not which of these three. Two questions, in order. What is the recipe? And then, which jar do I want to carry it in? Question 1 decides what you actually own. Question 2 decides how you buy it, what it costs to run, and how the tax lands. That is the whole map. And Jay was never wrong. He bought a real thing, holding real companies, and it did exactly what it was built to do. He just did not know which jar was in his hand. That is not a money mistake. It is a vocabulary problem nobody fixed for him. 3 jars on a shelf. The same soup in all of them. The only word that told you what was inside was the recipe, and everyone was busy reading the lids. So here is the one thing worth doing today, and it costs nothing. Open whatever you already hold, if you hold anything. Find 2 lines, what it tracks or how it chooses, and its expense ratio. Both are printed in the fund's own documents. Nobody hides them. You are not looking for a verdict. You are just answering the 2 questions yourself instead of letting an app answer them for you. If that reframe made 3 confusing words, finally sit still, subscribe. Understanding the wrapper is the step almost nobody gets shown. And if you want the layer underneath this one, watch how investing actually works next, where we follow what a share of a company really is. Same soup, different jars. The only thing that ever changed was who was reading the label.